Good morning. This is Barry Knapp with Ironside's Macroeconomics. It is 7:30 a.m. Mountain Time on Monday morning, May 12th. Our note this week was titled "The Battle Over the Budget," and one of the primary themes of the note was that we thought we would move on from focusing on trade policy to focusing on the more important, in our view, in the long run for productivity, growth, earnings, margins, and so on and so forth, which is our budget deficit. And so we'd move on from focusing on trade policy to the reconciliation bill, and that's a lot of what the the note was about. So we began with a discussion wrapping up the Fed meeting last week, where Chair Powell tried his hardest not to make any news, but he did give away a little bit in the sense that he said, if anything, they thought they were late last year. Now, that seemed to go unnoticed by a lot of people, but in fact, there were two important indicators, albeit second-tier indicators, that came out on the day of the Fed meeting that really did underscore the underlying condition of the labor market, foundation of it, which we think is particularly weak for the small business sector in particular. And so we got the Atlanta Fed Wage Tracker series, and it showed continued pressure on lower income, less skilled parts of the labor market. And we got the business employment dynamics that shows that small business employment had indeed been vastly overestimated by the birth-death model as late as the third quarter of last year. That's when we have the most recent data from, after BLS combs through 13 million IRS records. In fact, small business job creation was negative 140,000 in the third quarter of last year. So when the Fed kicked off with a 50 basis point rate cut, we truly were on the verge of a nonlinear increase in the unemployment rate. And they may very well have contributed to stabilizing that, along with election-related optimism. But if you look at small business employment from the ADP report right now, it's just as weak as it was at that time. So the Fed could very well, and we sort of described it as the Fed put is in an exotic or knock-in option, where if that were to start manifesting itself in the labor market data, the monthly data, the Fed could kick off, restart the recalibration process with another 50. So that's how to think about Fed policy. I know this morning, in the wake of the trade deal or detente, Fed expectations have been slashed, but we still have this underlying problem with the small business part of the labor market. And so you can think of that in terms of a Fed put. This is obviously inflation week, and we went through details on just how disinflationary the process is in housing-related inflation. And seasonally, we're likely to see a quarter of weak non-housing services, or so-called super core inflation. So with all the focus on goods, we think it's a little unwarranted. And we think one way or another, the Fed's going to be cutting rates as the trade fog clears. We then moved on to a discussion about some of the unintended consequences of this trade policy, having been highlighted by the 9% spike in the Taiwan dollar while we were traveling a week or so ago, and how there's going to be all sorts of unintended consequences of attempting to shrink our deficits, encouraging our Asian partners not to manipulate or suppress their currency by buying U.S. Treasuries. Well, that means less demand for U.S. Treasuries, which gets us to the real story of the note this week, which was the progress of the reconciliation bill. So I'll keep this brief. If you're a paid subscriber, you can get all the details. The corporate tax portion of the reconciliation bill seems to be going quite well. That should help business confidence. The individual tax stuff, we're struck by how this is not Reagan's Republican Party any longer. And the spending side, Congress seems to be getting weak knees on. There's a proposal out there for Medicaid that is about $300 billion smaller over the 10-year time horizon than was originally intended. Yes, they look like they'll put some work requirements on it for able-bodied prime age males, they certainly should do that. But they seem to be getting weak knees about really cutting spending, which for us makes our year-end forecast for a 4.5% 10-year Treasury look pretty shaky. And a retest of 5 is certainly possible if Congress loses their nerve and does not return spending to 20.5% of GDP. It can be over time. By the end of Trump's presidency would be fine as long as the laws are in place that start slowing the growth rate of spending. So that's it for me this week. As far as the markets go, we wouldn't be adding any duration here for sure, even though we do think the Fed could wind up cutting. And as far as equities go, we worked in the note through how we don't like the healthcare sector. Still a little shaky on our energy long, but are good being long energy and financials in particular. Bearing that from our insights. Have a good week, everyone. Thank you.